Hi and welcome to my YouTube channel. How are you? Today I will make a video of December exam answers. It's for those who has taken the exam for F6 P6 P6 for advanced taxation exam, December exam. So we got the answers now, so which I will show you in a while. So please make sure that you subscribe to my channel, and plus you watch my channel for like 2 or 3 4 hours in return for this favor. So it's gonna be helpful for me to gain more subscribers, to monetize my channel. And I have to have 1000 subscribers and 4000 hours. So if you contribute in this, it's gonna be helpful for me. So I will show you all those videos with the answers and explaining how you should answer in your exam, in December exam. Please make sure you subscribe to my channel for more videos and watch my other videos for 2 hours or 4 hours. So it's gonna be helpful. It's gonna be mutual helpful for each other, mutual beneficial for each other. So for let's do it. I'm gonna show you the next videos will be the answers for December exam. Thank you for subscribing and watching my channel, and stay tuned. Keep commenting. Let me know what video you want me to make, or what do you want, then I will make a video on this. Thank you. Bye. I will show you the before I say bye, I will show you the other videos. I will gonna in next videos you're gonna see all those answers for December exam.
Let's try this exam question from the September 20 exam on overseas permanent establishments updated for this tax year. So they want us to list the implications of making an election to exempt the profits of J Limited's overseas permanent establishment from UK tax. Now, if we have an overseas permanent establishment and we are making an election to exempt the profits of the overseas permanent establishment from UK tax, there are some standard implications. What are the standard implications? The first one is that this election is irrevocable, so it cannot be cancelled. Once you've made it, that's it. The second is that it will apply to this current overseas permanent establishment and all future overseas permanent establishments. Now also, if losses are generated by this overseas permanent establishment, they cannot be surrendered to our other UK group members. So if it is a loss-making overseas permanent establishment, it's better actually not to make the election so that we can surrender the losses to our UK group members. However, if it is a profit-making permanent establishment and the tax in the overseas country is less, then it's actually sensible to make this election because you would be paying less tax overall. So let's see what information we have. This is a potential investment in J Limited. They are in discussion with the management regarding the establishment of this new company, J Limited. If it proceeds, the company will commence trading on the 1st of April 2021. It is expected to be profitable in the year ending 31st March 22, but there is a possibility that it will be making losses in either this year or future years. The expected tax-adjusted trading profit for the year ended 31st March 22 is $135,000, and all of this relates to the activities in the overseas country. It's not yet been determined whether this company will be resident in the UK or in the overseas country, but if it is resident in the UK, it will be considered to be carrying on its business through a permanent establishment in Korea, the overseas country. And they are considering making the election to exempt the trading profits from UK tax. The tax in the overseas country is 13%, and there is no double tax treaty between the UK and that country. So, if we are making the election, This election cannot be revoked, it cannot be cancelled. It will apply to this overseas permanent establishment, J, and any future ones. If it makes losses, which is a possibility, we cannot surrender to any of our UK group members. They have said that it is possible that it will make losses in this year or future years. However, if it makes a profit and the tax in the overseas country is less, it is sensible because we are paying less tax. Now they have budgeted a profit of 135,000. The tax in the overseas country is 13%, which is less than the UK of 19%. If we do not make this election, then these profits of 135,000 will be subject to the 19%, and we will get double taxation relief of the lower amount of 13%. So we will be paying an additional 6% if we do not make this election, if this company is profitable. So if it is profitable, we should make the election, but if it is loss making, we cannot surrender the losses to our UK group members, so we should not make the election. So we need to weigh both of these possibilities and then consider what to do. Let's try this exam question from the September 20 exam on controlled foreign companies. So our requirement: they can confirm that a CFC charge will not arise if J Limited is resident in Garia. However, I want to provide them with an explanation of the purpose of the CFC rules and the charge which can be levied under them. Now, let's see what information we have. This is a potential investment in J Limited. We are in discussion with the management of CRO Limited regarding the establishment of a new company, J Limited. If it proceeds, J Limited will commence trading on the 1st of April 2021 and carry on its business activities in the country of Garia, where it will manufacture computer components. CRO is proposing that REP will own 30% of the ordinary share capital of J, with CRO owning the remaining of 70%. However, as we regard this potential investment as somewhat risky, if we decide to proceed, we may just want to own 20% of J rather than 30%. J's tax-adjusted trading profit for the year ended 31st March 22 is budgeted to be £135,000, all of which will relate to the trading activities in Garia, and they will have no other source of taxable income and will not make any chargeable gains during the year. They have been advised that if J Limited is resident in Garia, this will not result in a charge under the controlled company under the CFC rules. REP and CRO are both UK resident companies. Now, first things first, will J Limited be regarded as a controlled foreign company? Is it controlled from the UK? And is it resident overseas? Yes, it is. Whether this REP owns 20% or 30%, because both CRO and REP are resident in the UK and they are controlling J Limited, it will be controlled from the UK. And yes, J Limited is resident in the country of Garia, so it is resident overseas. It will be considered to be a controlled foreign company. However, why will no CFC charge arise? Well, it satisfies two of the exceptions. Only one exception needs to be satisfied for the charge not to arise, but here it satisfied two exemptions. The profits from trading activities must be less than £500,000 and from non-trading activities must be less than £50,000. Well, here the profits from trading activities were only £135,000, therefore it is less than the £500,000 and we have no income from non-trading activities. Also, just to show you, another exception is satisfied. Within the first 12 months of trading, the exception is there will be no CFC charge. And they are now starting to trade on the 1st of April 21. So both of these exceptions are satisfied. This is why there is no CFC charge that is going to be levied on J Limited over here. It is a CFC, but no CFC charge because we have two exceptions being satisfied where we actually only need one to be satisfied. Let's try this exam question from the September 20 exam, question 2C on domicile. So the requirement is to explain whether or not a gift of land by Alvaro to Freya at some time in the next 12 months could result in a UK inheritance tax liability. And here we have the information. The gift is a land in Benita, the country of Benita. Freya's father, Alvaro, has moved to the UK and become UK resident on the 6th of April 2006. His domicile of origin is Benita, and he has owned a plot of land in Benita for many years. He is considering giving this land to Freya within the next 12 months. Alvaro is not well and is unlikely to live for a further 7 years, and we should therefore assume all future potentially exempt transfers will become chargeable to IHT. Also, because he makes regular substantial lifetime gifts, there will be no nil rate band or annual exemptions in respect of the gift of this land. Now in our question, we are asked to assume that today's date is the 7th of September 2020. So he is planning to make this gift, let's say in the next 12 months on the 7th of September 2021. Now, as this is a gift of an asset overseas, he will only be liable to UK inheritance tax if he is either domiciled in the UK or deemed domicile in the UK. His domicile in the UK currently is in Benita. Will he be deemed domicile in the UK via the long-term residency test? Well, we need two conditions to be satisfied. He would have had to be UK resident in 15 out of the 20 tax years immediately preceding the one when he is making the gift. He is making the gift in 2021 because he's making it in the next 12 months. Therefore, he would have been resident in 2006, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, and 20. That's the one preceding. This is how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So this condition is satisfied. Now there is another condition. He must be UK resident in one of the 4 years immediately in the year ending with the current tax year that he is making the gift. Well, he's been resident since 2006, so this is also satisfied. Therefore, he is going to be deemed domicile in the UK via the long-term residency test. Now, if you are making a gift of an overseas asset, but he is deemed domicile in the UK, then this asset will also be liable to UK inheritance tax, which is what they have asked us. Now, as it is liable to UK inheritance tax and they have told us that no nil rate band or any annual exemptions are available, then yes, it will be chargeable to UK inheritance tax. One thing that we need to understand over here is that the land is situated in a separate country and he is domiciled in this country. So he may have to pay inheritance tax also in this country, and he would also have to pay UK IHT. Therefore, he will also get double taxation relief, either of the UK IHT or the Benita IHT. Now, this is the father. If the daughter, Freya, is making a gift of this land also, well, we will have to look at her domicile and see whether she is UK domiciled or deemed domiciled to see whether it would be chargeable to UK IHT. But right now the father is making the gift, and this is what we would have to consider. And there we have it. Let's try this exam question from the September-December 20 exam, updated for this tax year. So this part of the question is on trading loss relief for an individual. They want us to state the reliefs that are available to Amelia in respect of her trading loss for the year ending 31st December 20, on the assumption that Amelia does not wish to carry forward any of the loss. Let's see what information we have. Amelia is a sole trader. She has her own unincorporated business for many years. This is her savings income. She has some rental income and no rental income in the tax year of the loss, as the letting ceased on the 31st of March 20. Now, what reliefs will be available to her for a trading loss if she does not want to carry it forward? She is an individual with an unincorporated business who has a trading loss and she does not want to carry it forward. Well, the first relief that is available to her is to use it against her total income of the current year, and after she has done that, if she has any capital gains of the current year, she can use it there also. The second relief that is available to her is to use it against the total income of the previous year, and here also, after she's used it against the total income of the previous year, if she has any capital gains of the previous year, she can also use the loss against there. As she does not want to carry forward the loss, these are the only two reliefs that are available to her, because the opening year's relief is not available to her as she has been in trade for a very long time, and the terminal loss relief is also not available to her as she is not ceasing her business. So either total income of current year plus capital gains of current year, or the total income of the previous year and the capital gains of the previous year. All four of these reliefs can be used. The only condition is that to use a capital gain of a specific year, the total income of that year must be used first. And there you have it. Let's try this exam question from the September-December 20 exam. So in this part, they want us to explain with supporting calculations how much tax will be saved for each of the reliefs identified in the requirement A1. Now, the reliefs identified for the trading loss in the first part of the requirement were that for the trading loss that happened in 2021, she could use it against the total income of 2021, and after that she could go to the capital gains, or she could use it against the total income of 1920, and after that she could go to the capital gains. Here we want to look at the tax saving of using either of these reliefs. So let us look at this one first, and then this one we'll look at second and see which one saves the most tax. So let's first look at what is my total income that I have for 2021. Let's see what information we have been given. Here we have Amelia, who is a sole trader. She has been in trading for many years. She has savings income of $6,000 each year. She has rental income of $11,600 from a UK residential property, but that is in 1920. She does not have it in 2021 as she has sold the property on the 30th of April 20. Now, that is her income. What were her trading results? For this year, we had the loss of $14,000 that we are looking for relief for. And in the previous year, she has had trading income of $30,000. Well, first of all, since we are looking at the total income of 2021, there was just savings income of $6,000 that we had. We are allowed to use the total income and the capital gain of that year. So let me also look at the capital gains of this year one time. The capital gains of this year. Let's see what information we have over here. Her recent capital disposals. A painting was sold on the 1st of June 19. This is in the 1920 tax year, and this created a loss of $11,000. Then she has sold that UK rental property. This is a residential property, and she has sold it in this tax year for $45,000. And she has also sold shares in an unquoted trading company for $28,000. All of the disposals were made to unconnected person, never lived in the rental property. This is an unquoted trading company and she has sold the whole of her 3% holding. This immediately shows us that she will not get entrepreneur relief on this because it's only a 3% holding and she has never worked there. So let me see what we have. For the capital gains, I need to actually split it into residential gains and non-residential gains. The residential gain was the 45,000 and here we had the 28,000 on the sale of the shares. Now what we are going to do for this is we are first going to calculate the tax payable without giving the trading loss of 14,000, and then we are going to calculate the tax payable with giving the trading loss so we can actually see what is the saving with the trading loss. Well, first of all, for the savings income, this would be covered entirely by the personal allowance this year, so there would be no tax payable this year, there is no taxable income, and there is no tax payable. That's fine over here. Let's come to the capital gain. Well, what would we do in this situation? The residential gain and the non-residential gain. We have a capital loss brought forward from the previous year that we will always give to the residential gain because this pays tax at the higher rate. My annual exemption also always given to the residential gain because it pays tax at the higher rate. So what is my final taxable gain? It is this plus this plus this. This one is residential and the non-residential is this. Now realize that we have no taxable income over here, so we have my full basic band available, again going fully to the residential gain. That means that I will have 22,000 and this will be at the 18% because this falls into the basic band entirely. Let me just put this in the percentage. This I need to make a percentage. Great, this is 18%. Now how much of this falls into the basic band? Well, my basic band is 37,500. If I'm subtracting this amount, then 15,500 of this gain falls into the basic band and this will be taxed at the 10% rate. Again, I'll make this a percentage over here. And how much of this is remaining then to go into the higher band? This much will be taxed at the 20% rate. This here I will have at 20%. What is the capital gains tax payable without using my trading loss? This multiplied by this, here also this multiplied by this, and here also this multiplied by this. What is the total capital gains tax payable without using the trading loss? The capital gains tax payable will be 8010. This is without the trading loss. Now with the trading loss, what is going to happen? Well, I had savings income of 6,000. Remember that if I want to use the capital gains of the year, I must first use the trading loss here. So the trading loss will be used over here. Subtract 6,000. Again, my taxable income is 0. Now there was no saving over here because we had this covered by the personal allowance anyways, and therefore there is no tax saving. It was anyways covered by the personal allowance. But when we come to the capital gains, what is the saving? Well, I'm going to put residential and non-residential here again for us. This was 45,000, I believe, and this was 28,000. Now, here we have the capital loss brought forward. We will also have my trading loss remaining, and we will have the annual exemption. This was 11,000. The trading loss remaining, the trading loss is 14,000. Here I've used 6,000. So 8,000 is remaining over here, and my annual exemption again over here. How much residential gain do I have? It is this plus this plus this plus this. This is my residential gain. This is also going to be 28,000. Great. So let's see now how much I'm going to tax. 14,000 fully at the 18% rate because that falls into my basic band entirely. How much of the basic band do I have remaining? My basic band is 37,500 minus what I've used already. 23,500 will be at the 10% rate, which I'm going to put over here. And then it's just the remaining gain minus what fell into the basic band. This will be at the 20% rate. So how much tax is going to be payable if I use the trading loss? This multiplied by this, here again this multiplied by this, and here again this multiplied by this. Okay, what's the total of the capital gains tax if I'm using the trading loss? This until this, 5770. So if I use the trading loss against the total income and capital gain for 2021, what was my saving? Well, without it, I had to pay 8010, and with it, I have to pay 5770. So 8010 minus my 5770, my saving is going to be 2240. Great. This is the saving if I am using the trading loss and capital gain of 2021 over here. Now let's come to the second one using the total income of the previous year and the capital gain and see if that gives us a larger or a smaller saving. So let's come down. We need to find my total income of 1920. Well, I know that I had trading income, I had savings income, and I had rental income. Realize that I only had a capital loss that year, so we'll only be using it against these three. What was the trading income? It was 30,000. Savings income was 6,000, and this was 11,600. Great. What is my total income? My total income is equals to the sum of this until this over here. Now again, we're going to do it the exact same way. We are going to calculate it where we have no trading loss, and then we're going to calculate it where we actually do have a trading loss being used over here. Without the trading loss, I'll get my personal allowance of 12,500. So what does my taxable income become over here? It is equals to this plus this. Now, as we see, we are a basic band payer over here. So what's going to happen in this situation? Out of this, I will have 1,000 taxed at 0%. Let's try that again. I will have 1,000 taxed at 0%. Why is that? Because I will get the nil rate band for my savings income that's over here, and the remaining amount of 34,100 I will have taxed at 20%. So what is this in a percentage? 20%. What's my tax that I'm going to pay? My tax that I'm going to pay is 6820. That's great. Now, if I gave the trading loss of 14,000 over here, what would the tax saving be at? Since I'm paying almost everything at 20%, the tax saving would also just be at 20%. So let's see what the saving is going to be if I give the trading loss over here. It is going to be 14,000 multiplied by this 20% over here. It's going to be 2,800 is going to be the tax saving. Now, what gives us a higher tax saving? 2,240 or 2,800? Of course, I should use it against the total income of 1,920, as that gave me a higher tax saving of 2,800 that we have seen over here. I didn't need to recalculate everything because I saw that most income is just paying 20%. So if I gave this trading loss here, the saving would also be at 20%, and using it against this year gives me the higher saving. Let's try this exam question from the September 20 exam updated for this tax year. So they want us to explain with supporting calculations the capital gains tax and income tax implications for Amelia of the proposed sale of Warehouse 1 and the acquisition of Warehouse 2 and the forklift truck. So let's first look at the capital gains tax implications, and then we will look at the income tax implications. The proposed sale of Warehouse 1. She's acquired this warehouse in 2014 for $86,000. She will sell it on the 1st of May 2021 for its expected market value at the date at that date of 118,000. Her trading company occupies 3 out of the 4 floors of the warehouse, and the remaining floor has always been rented to tenants throughout Amelia's ownership of the building. Now, this is the sale of one warehouse, and her purchase of the other warehouse is going to be in March 2021, just 2 months before the sale. So we see that the qualifying time period for rollover relief is achieved. It is within 12 months previously. She's purchasing a warehouse for 83,000 and a forklift truck for 23,000. Both will qualify for rollover relief because it is plant and machinery and land and buildings. They are also being both used in the trade of her business. So let us see. Over here, her sale proceeds are 118,000. Her cost is 86,000. What is the capital gain that we will have over here? It is equals to this plus this. Now, how much of the gain can qualify for rollover relief? They told us that she has used 3 of the floors in her trade, and the 4th floor was always rented out. So only 3/4 of this can qualify for rollover relief. Multiplied by this amount. This is the amount that qualifies for rollover relief. But before we give this rollover relief amount, we need to see how much she has actually reinvested. Has she reinvested the amount that will also allow this to be rolled over? Well, she has reinvested 83,000 in the warehouse and 23,000 in the truck. She has reinvested 106,000. How much has she not reinvested? Because the amount that's not reinvested must become a chargeable gain now. This minus this. 12,000 of this 32,000 gain must be chargeable now because this is the amount that is not reinvested. So, even though 24,000 qualifies for rollover relief, we will get less rollover relief because she has not reinvested the 12,000 amount. My capital gain over here is 32,000. How much qualifies for rollover relief? Well, she's not reinvested this amount. So what is chargeable now is the amount that she has not reinvested. 12,000 will be chargeable now. How much of the gain can be rolled over? It is, of course, 20,000 as you see. This minus this. This is going to be our rolled over gain. That means that what is the base cost of our new assets? Well, she has reinvested, she's reinvested 106,000, and the gain that is rolled over is going to be 20,000. So what is the base cost? The base cost is going to be this plus this. This is the base cost of the new assets when she sells them. This is what she can use. Now, just once again, this amount qualified for rollover relief, 3/4 of the gain. But because she had not reinvested 12,000 of what she received, that amount of gain had to be chargeable now, and we could only roll over 20,000 even though 24,000 qualified. And therefore, we subtracted it from the reinvested amount, and this gave me the base cost. Now, this is my capital gains tax implication. The overall implication is that I had a capital gain of 32,000. This will be chargeable now. This will be rolled over. It is likely that this is covered by the annual exemption, so no capital gains tax will actually have to be payable because it's only 12,000. Now, coming further, what are the income tax implications that they want us to talk about? We have purchased a forklift truck. This is for use in the trade. This is plant and machinery. Therefore, for income tax, it will qualify for the annual investment allowance and the writing down allowance of 18% as it will go into the main pool. So in 2021, we have to see how much are our purchases, and we can use the annual investment allowance for the forklift truck, and if it falls over into the main pool, then we will get 18%. For the warehouse, as the warehouse has been purchased after the 6th of April 2020, it will get the structural buildings allowance at 3%. This is a straight line allowance given for 33 years and 4 months. However, it is not going to get it for the entire year because they have told us that the warehouse is going to be brought into business to use in her business from the 1st of May 21. So therefore, we will get the 83,000 multiplied by the 3%. Of course, it is a straight line allowance, but since it's only being used for 11 months in that year, it will be 11 out of 12 months. This will be the SBA for the warehouse. This is not the same for plant and machinery. They will get the full year of annual investment allowance in WDA because it is bought within 2021. But for the SBA, you need to see exactly when it was bought to use in the trade for the warehouse, and therefore it will get 11 months as it was brought into use on the 1st of May. So these are my capital gains tax implications and my income tax implications. Let's try this exam question from the September 20 exam updated for this tax year. So they want us to explain why Amelia can apply to voluntarily deregister for VAT on the 31st of December 20, from what date her VAT registration would be cancelled, and the immediate consequences for her of deregistering. Now, you are allowed to deregister for VAT if your expected taxable turnover over the next 12 months is expected to fall below 83,000. She wants to deregister on the 31st of December 20. So let's look at the next 12 months. What is her expected taxable turnover? It is forecast to be 79,000, and therefore she can voluntarily deregister for VAT on the 31st of December 20 because the next 12 months is below 83,000. Now, what else have they asked us? They've asked us from what date the VAT registration would be cancelled. Well, she's deregistering on the 31st of December 20, so it would be this date or an agreed earlier date between her and HMRC. And finally, what are the consequences of deregistration? Well, she would not be charging output VAT anymore, and she cannot claim input VAT on her standard rated purchases. So no output VAT on standard rated supplies and no claiming input VAT on standard rated purchases as she is deregistered for VAT. Let's try this exam question on closed companies from the September 20 exam. So they want us to explain why Top Limited is classed as a closed company. Now, when will Top Limited be classed as a closed company? Either it will be controlled by any number of directors who are also shareholders, or it will be controlled by its 5 largest shareholders. Now, there's one more thing that goes here. A company is controlled when, of course, 50% or more of the share capital is owned by these shareholders. And here, with regards to a closed company, there is a special definition of what a shareholder is. It is the shares owned by the shareholder personally and any shares owned by his associates. And who are the associates or the shareholders in this situation? For there are direct relatives or business partners. So let us see what information we have, and let's see if either of these two conditions are satisfied. Here I have Top Limited as a UK resident trading company, and they have told us that it is a closed company, but they want us to explain why. It has 6 directors, Dorian and 5 other directors, and it also has unrelated individuals. These are the shareholders. The shares in the company are held as follows. Dorian owns 5%. The other 5 directors own 25%. Now, this is only a 30% holding, But remember, when we are talking about a shareholder for a closed company, it is the shares owned by the shareholder personally and any shares owned by his associates, which include direct relatives. Dorian's father, Basil, he owns 23%. That means that what is the percentage we are looking at? 5 plus 25, the other directors, plus 23%. This gives me a 53% holding, which is more than the 50% holding. Therefore, T Limited is controlled by any number of directors who are also shareholders. This was Dorian and the other directors, but here the shareholder had an associate who also owned shares, so that was included, and that's how we have crossed the 50% holding. 53% is held and this condition is satisfied. This is the reason that T Limited is a closed company. Let's try this exam question from the December 20 exam on filing corporation tax returns. Now, we know that whether a company is large or small, the corporation tax return needs to be filed within 12 months from the end of the chargeable accounting period. If it is less than 3 months late being filed, the penalty is going to be £100, and if it is between 3 to 6 months late, the penalty is 10% of the unpaid tax. So let's see what information and requirements we have. They want us to state with reasons the due date for filing T Limited's corporation tax return for the year ended 30th April 19 and the implications for T Limited in respect to filing it late. They have filed its corporation tax return for the year ended 30th of April 19 on the 29th of August 20. When should it have been filed? 30th of April 2019. 12 months means 30th of April 2020. They have filed it when? They have filed it on the 29th of August 2020. How many months late is that? May, June, July, and August. It is 4 months late. Therefore, if it is 4 months late, we are falling into this category, and it will be, the penalty will be 10% of the unpaid tax. Let's actually look at the previous year also, because I believe that was also filed late. For the 30th of April 2018, it should have been filed on the 30th of April 2019. When did they file? They filed on the 6th of July 19. How many months late is that? 6th of July 2019. That's May, June, and July. Therefore, it is 3 months late, or just within 3 months. So this would have been the penalty for that time. So we have the penalties for here and we have the penalties for here. Now remember, we are talking about filing. Okay, we are not talking about paying corporation tax. If corporation tax is paid late, then we will have late payment interest, and there will be a different penalty depending on the reason altogether. For this company, they have told us that they are not a large company for corporation tax to be paid in installments. So corporation tax for this company needs to be paid 9 months and 1 day after the chargeable accounting period. However, they have asked us about filing, so we have told them about the filing requirements and the penalties.